Hey everybody, welcome to another Bitcoin Intelligence show. Today we're going to go over Monday's Bitcoin Intelligence report. I'm going to begin with the executive summary. So the report is titled The Big Divergence, The Chain Cools as Macro Warms Up. Essentially, we are observing some really bullish signs in the macro environment, but signs of cooling and lack of demand in the on-chain data. So the report starts with the executive summary. If you want to access the full report, you need to sign up and subscribe to Bitcoin Intelligence platform. So the report mentions that there is a divergence, which might sound unsettling for a lot of people, but we want to highlight that the opportunity actually lies in a setup like this. The long term is really bullish. In the short term, Bitcoin is stuck in a trading range. So we're witnessing a striking divergence, short-term weakness in Bitcoin colliding with rapidly improving long-term macro backdrop. On-chain and futures activity reflect fading momentum and weak demand, yet beneath the surface inflation is cooling, the Fed is turning dovish, liquidity is building into the second half of 2025, and the macro landscape is looking more bullish than ever. Bitcoin, however, remains pinned between 100K and 115K, a range that will not last. We've been highlighting for quite several weeks that Bitcoin needs to take a break, and it has been taking a break since then, but this range will not last for much longer. This is a calm before a move, and in this divergence lies the opportunity. So let's understand what's going on here. As always, our report covers both a macro and liquidity section as well as an on-chain section. The macro segment will first look at Iran-Israel war and its likely ramifications for global energy, inflation, and central banks. We review what happened and what can happen to the energy market. We then look more deeply into the most critical maritime choke point in the global energy system, Strait of Hormuz. We examine how energy disruption could impact inflation and assess war's impact or lack thereof on our broader macro outlook. In this part, we present a very clear outlook for the second half of 2025. So we have a lot of confidence in our view about 2025. In the monetary mechanics segment, we review three critical signals from the past week worth watching. One of them is Bitcoin sold off, but not as much. It's a very controlled, very contained sell-off. And it recovered pretty quickly because it's the most liquid asset on earth. If something happens over the weekend, if the war breaks over the weekend, people sell what they can, not what they want. So Bitcoin sold off and it quickly pared back a lot of those losses. Meanwhile, long-term Treasury saw strong foreign demand despite weak dealer participation, highlighting structural strength, not dysfunction. So while a lot of people have been claiming that the bond market is going to collapse and people are not going to buy U.S. Treasuries, this 30-year bond auction showed that there is very strong demand. The bond market is going to stabilize, and it has stabilized in the last few weeks, and that's going to be very helpful and positive for equities and Bitcoin. And perhaps most importantly, the Fed's regulatory leadership signaled a potential shift that could re-engage the banking system after years of retreat. So there are important signs of a major move in the way regulators are thinking about banks and allowing them to pare back some of the regulations that really hampered the banking system after the 2008 crisis, such that the banks can now take more risks and provide much more liquidity to the economy, which is also going to be very bullish for the latter part of 2025. We also have an on-chain segment that is very rich this week, with several important signals highlighted. But overall, it shows a cool down in Bitcoin for the moment. We look at rate of capital inflow that's cooling. We look at short-term holder profits that are eroding. We look at the spot volume on central exchanges that is down, signaling a spot trader exhaustion. This is this chart showing exhaustion of traders in the centralized exchanges. We also find that implied volatility is at one of the lowest levels. which typically signals imminent rise in volatility. Open interest and funding rates are both declining. So in the futures market, we also see a decline, and leverage traders are stepping aside rather than reinforcing the existing rally. In the past few weeks, we have emphasized that Bitcoin needs to take a breather, and since then we've stayed in a range, particularly in the Wednesday report. So this would be last week's Wednesday, when Bitcoin was trading at 109. We highlighted the emerging bearish structure and identified 104 as a major support zone, as well as a few other zones lower than that, in the low 90s and high 80s. And since then, the price has declined, and it seems that we've stabilized around 105. This is as of Sunday, when we were writing the report. But the data we are looking at in on-chain data still doesn't show a meaningful return of demand, so we will likely stay in that range for some more time. Finally, on-chain data show two important price thresholds to exit this range. So from a price perspective, when are we fully confident that the range-bound price action is complete and a new leg is beginning? That's if we move below 100K or above 115. These are derived not from technical analysis, but from on-chain data, showing that if the price moves out of these numbers, out of these thresholds, then the structure has completely changed, and we are beginning to see a new trend. A break either way would indicate end of consolidation. However, keep in mind that all this is occurring in the backdrop of liquidity ramping up. This is why our report is really unique, because it looks at both economic and monetary factors, as well as on-chain. So if you just look at on-chain, you will have a very bearish view at this point. But we also realize that the backdrop of liquidity is very, very bullish. So over time, even if the lack of demand pushes Bitcoin step by step lower, it will collide with a massive wave of liquidity that's coming in the next few months. And another leg will start exactly like the last few years, where Bitcoin does a massive spike in a short period of time, and then spends a long period consolidating or slow bleeding until another leg begins. So we're seeing everything is essentially shaping up for that kind of a move to happen here. All right, so this wraps up our executive summary. Again, if you'd like to read the full report, you need to sign up on the platform to access the report, as well as the videos and other charts and models that we have made available. All right, so I'll spend a little bit more time reviewing the macro section, and then Wizard will begin discussing the on-chain data. So in the macro section, we look at one of the most important events of the week, which is Iran-Israel conflict. Israel is bombing Iran, and Iran is launching missiles on them. So one of the most important economic impact of this is going to be the impact on oil. Why is that important? Because Iran controls one of the most important logistical points for global energy system, which is the Strait of Hormuz. It is the most critical maritime choke point in the global energy system. It's a very small, narrow area, 21-mile wide waterway that controls 20% of the global oil. So several countries are exporting their oil through that strait, which includes Saudi Arabia, Iran, Iraq, and UAE. And they're essentially stuck in a place like this. All these countries, the oil field are positioned around this Gulf, Persian Gulf, which forces them to have to export the oil through the Straits of Hormuz, which is here. So there's no other way, basically. If something happens here, if Iran or Israel drop some bombs here or create a significant uncertainty in this waterway such that the oil cannot be exported, then we will have major trouble here. We will have immediate disruption in the oil market. However, it's important to note that a lot of the oil that passes through this waterway goes to Eastern Asia, not the West, including, so that includes China, Japan, and India. So they will be a lot more impacted by a potential disruption in here. As expected, oil prices have gone up significantly. Again, these are data as of Sunday night, where the report was written. However, a really good a story here in the background is that the inflation is easing. So PCE is on its way down. The CPI is on its way down. CPI has printed only 1% annualized inflation over the last 3 months. PCE has printed 2.13% in the last 3 months annualized. Also, year over year is down to 2.15. Pretty close, almost a hair above the Fed's 2% target. PPI inflation is also very, very low, almost deflationary, guiding that it is very likely that the CPI and PCE numbers would keep going down, even if we are worried we might be seeing some positive price pressure from tariffs. Still, the larger background is economic slowdown and deflation. So because of this, our macro outlook essentially remains bullish despite the war, despite the possible tariff effects. Why is that? First off, as I explained, inflation is cooling, and this is a macro trend, global macro trend that's not going to be derailed easily by a conflict or tariffs. At the same time, tariff tone is shifting. Again, the US and China are talking, and they're attempting to reach deals. Also, similar progress is happening with other parts of the world. So every month from now, the effective tariffs will be lower and lower, and more deals will be unveiled. As a result, the effective tariffs will be lowered, plus whatever that's the residual effect would have been priced in already. Bond market is stabilizing, as we explained, and you can read in more detail in the monetary mechanics section. We had a very, very positive, very strong bond auction with lots of foreign participation, showing that the bond market is really strong and stabilizing, which is going to be very good and positive for equities and Bitcoin. Energy risk may be temporary. So far, what we are learning from the war is that the attacks are not being are not directed at energy infrastructure that impacts oil exports. There have been some attacks on energy infrastructure that supplies energy to Iran for their internal demand. But there hasn't been any sign so far that this strait will be disrupted. One of the reasons for that is the United States has been very clear that if somebody tries to mess with Strait of Hormuz, their military will get involved. And I don't think Iran is in a place to want that. So it is possible that this ends up being a very limited worry, a very limited impact. And the Fed's hawkish force is eroding. We just got FOMC yesterday, where the Fed insisted on not cutting the rates and staying steady. But that will, but we still have 2 cuts planned for the rest of the year. When you look at dot plots, or also when you look at the trader positioning and the CME Fed Watch probability tool, 2 rate cuts are pretty much expected. And the Fed is kind of insisting that, hey, we are too worried about inflation again, which is against our playbook. And we think inflation will be very, very contained as it relates to tariffs. And in fact, we will have a lot more deflation everywhere else and in services. So the Fed's inflation worry is unwarranted in our view, but nevertheless, they're trying to hold off on cuts as much as possible. But any additional month that passes, they will be closer and closer to cuts. And then after that, after the year ends, we're getting closer to Chair Powell's end of term, where he will be replaced with a Trump guy, which would love. rate cuts. So a lot of rate cuts are coming moving forward. And lastly, during this summer, we are going to have tons of progress on tax cuts and deregulation, which they are both psychological and mechanical help to the market. Tax cuts are going to provide significant stimulus. There's a lot of liquidity that will be unleashed once this bill is passed, and also deregulation, as we discussed, is going to motivate the banking system to get more involved and provide more liquidity. So I'll stop here and have Z cover our on-chain section.
Hello, everyone. Thank you for tuning in for this week's 21st Capital Bitcoin Intelligence Report, going over on-chain section. I would like to start with just discussing what is this piece about. This piece is very focusing on the momentum, and as I'm gonna show you in next couple of minutes, it seems like the momentum is not returning to what it was a couple of weeks ago, and we will see the signs that are signaling the momentum is fading, and that makes the need for a catalyst very crucial. If we want to see a rally or a leg up, we need the catalyst to actually start trigger the demand. If it's not late already, we need it right now. Otherwise, most of the charts that we're going to go over is signaling the momentum is fading, and we probably going to see a midterm to long-term bear market. And I'm going to start with the very nice chart that is actually shown here on the screen. This chart is showing the realized price. Realized price is the cost basis of the market investors, and as you can see, we had a rally like started from 2023, but when you look at the slope or how fast this realized price is increasing, you can really see the confluence between the market strong upward momentum and the high slope in the realized price, which is showing the rate of capital inflowing to the market is logically in correlation with the price action and how fast market is moving up and down. And as you can see, since mid-April, this realized price was going up faster than what it was before earlier in April, and that was thanks to the market moving sharply towards the 100,000 plus 100,000. And now, like in late February, this slope is getting slow. The slope is getting like smaller and smaller, and shows that market is losing its momentum. To measure this slope, we have shown through rate of change here. The green is the delta or change in the realized price or realized cap. Both will give the same result. Is shown in the green, and the orange is the yearly moving average. If we go back and look at last couple of years, every time markets monthly change in the realized price or realized cap rallies above the yearly, that is the beginning of a very strong market momentum, and it goes, and we will go up to around 5.7 or plus 5. It's the threshold that when we see the market already had a very strong momentum, we can use plus 5 as a states in the market that shows the extreme capital inflow and potentially the exhaustion of the demand. And the recent rally to plus 108 was not an exception. As you can see, when we crashed, legged up to 108, 1010, this monthly change in the realized cap or realized price reached to its recent high and then start to slow down. Now, after market broke like in early June, like around 10th of early June, first week of June, this monthly moving average actually broke below the yearly, and it is now moving below the yearly, and now is below zero. That means it's becoming negative. The monthly rate of change in realized cap, or the rate of capital being deployed to the market, is now negative. So on a net basis, we're seeing the capital is slightly leaving the market. They were really close to equilibrium, and when we go back, usually breaking below the yearly and zero, which is like here, it is signing or triggering all the metrics or signs that are has a strong confluence with the beginning of the mid-term or long-term bear market. And looking at this metric alone, we can say with a good confidence that market has entered after failing to break above 1010 for a second time over the last month. Market entered and showed the signals of a short-term bear market thanks to the momentum fading. So the realized price momentum dropping is the early sign. Another sign that we can look at is the profitability, unrealized profitability of the new investors, which is the short-term MVRV. This is looking at the ratio between the market price to the cost basis of the new investors. By new investors, we're talking about the investors who entered market in the last 6 months, and usually the profit that they are sitting on is determining what is their reaction, what is their immediate reaction to the price action. And when the MVRV, like the previous structure that we discussed, the monthly to yearly, here we are comparing the MVRV to the yearly moving average. When the MVRV or the size of profit margin the recent investor sitting on is breaking above the yearly moving average, it is the beginning of the strong rally. And conversely, when this moving the MVRV breaks below the yearly its yearly moving average, it is the signal that we will see usually at the beginning of the bear market. So this is at least a midterm bear market. You could see we are still above the moving average, the yearly moving average, but since last week of May or late May, this moving MVRV is slowly degrading and getting closer to yearly. So that fading momentum in the market was actually highlighted earlier with this metric. You could see the moving average or the MVRV of the new investors were started dropping very earlier than the market momentum in general. This is another signal that's saying the rate of the size of profit for the new investors will start to degrade late May, and when the MVRV or the unrealized profit for these new investors start to degrade, that's going to lead to the lack of confidence, less hope for market keep going up among the new investors, and these are the consequences of the price failing to keep its momentum up. And when we look at the recent 2 weeks, we had like a little bit sideways, and the lack of momentum is more clear now. Like if we wanted to see, if we were trying to speculate about the market, we should have really look at this metric and see, okay, we had probably 1 or 2 days like what we had in October 2024 of this metric going sideways, then we see a catalyst and it go higher. But we have not seen this in almost like 4 weeks now or 3 weeks, and this is a strong indication that the market is not seeing the momentum it needs to keep going up. And frankly speaking, when we look at the highs at starting the 2023, early 2023, the MVRV was just picking about 1.2. That means like when we had plus 20% profit among the new investors, markets started to see some sort of the sell pressure by the new investors, and that led to a sideways or a small mid-term bear market. What happened recently after we tried to break above the 108 as a second rally, yes, we got almost to 1.17, but we have not reached to the highs that we saw in November or December 2024, in March 2024. That is in line with what we had discussed last week, that the recent rally was very significant, but in terms of like unrealized profit, compared to the previous highs, it was smaller. So it was a significant rally, but it was smaller than the recent one that we saw in last 2 years. It is some sort of like indication that market is already exhausted, and even though we saw a new all-time high, it could not sustain that momentum because we already have 2 or 3 wave of profit taking in the market. And I think if we go down with this slope in probably next week or early next week, we are at the decisive moment that if market fail to see that momentum, breaking below the yearly moving average is inevitable. So that is another strong confirmation of the bear market if we see that sign. Moving away from the momentum and lack of profitability, which both are very strong indication for a bear market in midterm, we can go look at the off-chain and see what's happening off-chain. Is the uh, trade volume on centralized exchanges is going up or down? Why is that important? When market is not seeing enough profitability of on chain, we can look into off chain and see if there is a confluence between the momentum on chain and the momentum off chain. And the best metric we can look at, and this is easy and simple to understand, is the spot volume. If you look at the spot volume, it was dropping since like December 2024. So in a sense, market was seeing a rally from 74 to 108, but that rally was not very it was a spot driven, but that rally was not having that support from the spot market that we had in late 2024. Still, we can see some uptick in the volume. So there was a spot influence or weight on this in this rally. We could see the spot market was really showing some support for the rally. But what happened is that peak is not comparable with 2024, late 2024. That means that rally was not as strong as the rally that we had in late 2024 in terms of the spot market volume. And the second thing that is noticeable, despite that uptick we had in up to late May, which was we were discussing when we were talking about the MVR of the short-term holder, since then the spot volume is dropping. So there's a divergence between the price and the trend in the spot market volume. That's saying that is speaking to the same conclusion we made in with last two chart, that price was going sideways, slightly downward pressure on the price thanks to the sell pressure by the long-term holder, as we discussed 2 weeks ago, and the short-term holders taking some profit because they were having like almost 17% on average unrealized profit. Now we're seeing that profit taking or price being stalled below the 110 has let the spot market's momentum drop as well, and the volume is almost below 6 billion. As you can see, every peak we had since early, or I mean April 2024, the market saw a rally when the spot and that rally was supported by the spot volume breaking above like around 6 billion. But right now we are breaking below 6 billion, which is pretty bearish compared to like last 1, 2, 3, 4 rallies that we had, and market had like a at least 1 or 2 week upward price momentum. So the spot market is signaling the same trend in the market, and that's a fading momentum. That being said, many might be interested to time when this sideways market is close to its ends. That is like a question all the time. No matter what side we're gonna break out of this range, we might go break above and break below. But timing the market price movement out of this range is really interesting question. And one of the metrics that comes to my mind most of the time when I face the same question is the implied volatility. Implied volatility in the market is a great tool that you can use to not to time exactly when market is about to break above, but you could see how, but like you can mathematically use this metric in conjunction with other metrics, and try to see, okay, the probability of breaking this range is very high. If we just use the recent 2 years of history, using the 1 week and 1 month implied volatility, you could see whenever we break below 40%, both in weekly and monthly time frame, market is close to its move out of the range. Like look at here in February 2024, after we break below 40%, market just rallied and moved out the range that it was just stuck into since 2 months before that breakout. And in June 2024, we broke below 40%, and market had a rally, even though it was a small one, out of a range that, or a downward pressure that market was just experiencing. Again, almost close to 40%, 41% in October 2024. Boom. A little bit like most of these examples that I went over was showing an example that when the implied volatility broke below 40%, market moved up. But that's not going to be the case all the time. Like I said, breaking below 40% for the implied volatility is just a indication that market is ready to break out of the range. It could be both side, up or down. We're just trying to time the breakout of that range. And a great example is February 2025, when the implied volatility was below, almost below 40% or close to 40%, and the market actually broke out of the range to the downside. So at the moment, we have been experiencing the same thing since first week of June. Both metrics were crashing or dropping below 40%, and this is a very, very um, interesting time, because when we imply volatility is below 40%, it means the option markets, the speculators are not pricing the volatility enough, and that is the moments the market is ready to go ballistic to either side. Now the question is, given that we are getting close to that breakout of the range time, which side we have to go, we are heading to. The first three charts that we reviewed were all pointing out we already had a rally, we already had an explosive move upward to go to 111, 100,011. So the probability of breaking below this range, I mean between 100,000 to 110, this is what we were like ranging in since like mid or late May. So right now, given that most of metrics that we discussed so far is showing the momentum is fading, the probability of breaking to lower numbers is higher than the breaking above this range, and that's also thanks to experiencing a huge long-term holder profit taking, as we discussed over the last 2 weeks. So all the indication, all the metrics that we discussed are indicating the downward pressure is more probable, and given that the implied volatility is low, that means the timing is pointing out that break out of this range is very imminent. And let's see what happened in terms of the open interest, because using the open interest, we can see in general what is the size of the speculation by the options traders. And if you can see, every high we had in this cycle was very, very in confluence with the option open interest having a new high. And that happened once, twice, and this is the third time. Even the OI in option is dropping, meaning the option traders or option speculators engagement is fading away. And when you see almost every single metric is pointing the same thing, and that's been so far the lack of momentum, the lack of interest or confidence in the market rally, you could add a check mark to your book. Let's say you have a qualitative framework to see if market is risky, market is entering a bear market, or no, market is actually getting ready to go upward. So when you're making a list, you can use just every single metric that we discussed and say, hey, if it is showing a lack of momentum, so I'll check mark the bear market probability. If it is showing an indication that no, the capital is coming in, the chance of market moving up is higher, you check mark the bucket that is showing that market is going to go up. And when you check mark for last 5 or 6 metrics that we discussed, all of them are just pointing out the market is heading south. And these confluences are very strong when you see cross on-chain, off-chain, especially on-chain and option. You could see this confluence is very, very meaningful inflection point in the market. And trying to just find this and discussing this confluence, one of the 2 metrics that I usually put them together is the funding rate, which is looking how hot is the appetite for longing in the market, or how much interest is how interested the long side of the futures market is in betting on the upward, paying the funding rate to betting on the upward, and how high is the SOPR, which is equivalent metric to funding rate, but it's only for the on-chain side. Here, when we put both these metrics together, you could see every high we had in the market was actually highlighted with the SOPR and the funding rate hitting a new high. And for the audiences that don't know what is SOPR is the ratio between the cost base and the market price to the cost basis of investors who are realizing profit, not all investors in one bucket, only the investors who are reacting to the price and they're taking profit or taking loss. When this metric, this is SOPR -1, so because SOPR equal to 1 is the equilibrium, SOPR -1 is the bias, the bias in comparison to the threshold or the midline. You could see the bias from the midline has reached to a recent high, and like the MVRV, it is showing it is not as high as what we had in late 2024, but it was like a high compared to the recent data. And all of them showed a peak when price reached to 111 in 22nd of May, and since then all metrics, including the funding rate, the market in general, the SOPR for market general is orange, and the new investors SOPR -1, the new investors SOPR, all of them are indicating, hey, the momentum is fading, even though prices held above 107, 105. There was a brief breakdown to 101, but the most of price action was trading above 104. And as you can see, while it was trading and holding by 104, all these metrics were showing the lack of momentum on the active side of investors. And when we put this next to all the metrics that discuss, the active investors are also showing some sort of like fading momentum and just stepping away from reacting to the price and less profitability in the market. And given that we need to look at the market structure and answer to this question, that are we in a high risk zone, or are we getting away from high risk zone? Oh no, we are on the low risk zone, and we are getting away from the low risk by seeing some spot rally in the market. This is all this material to discuss is going to help and just come together to answer this question. What is the structure of market telling us? If you want to answer this question, one of the very nice charts that Check and Chain have prepared is using the change in the open interest for the futures market, or like the open interest to future market in BTC term, and the y-axis here is the change in the price. So when we compare these two metrics next to each other, we can actually find out where we are in terms of the market's structure. When we were looking at the market 1 week ago, you could see we were in the leverage rally. Why? Because the price was increasing, the price was upward, and the open interest in BTC was going up as well. So while price was going up, the open interest or the futures traders engagement was increasing as well. So that is a great or textbook definition of the leverage rally, because the market is rallying up and the futures traders are joining the party. So that is a structure that we see usually while we are hitting a new all-time high or a new high. And after that, after we hit 1011 and then we corrected and tried again, and we were failing to break above 110, market is slightly moved towards just spot rally. That means the leverage traders were slowly stepping away, or were not showing the same level of appetite they were showing a couple of days ago. And from there, we could see slowly the price momentum is becoming negative, and all that time that the price momentum is losing its rate of change to the negative side, the open interest is degrading to the level that both are degrading at a very significant rate. That means price is dropping, market is losing its price momentum, and the open interest also is dropping as well. So when both happens on a significant level, this is a deleveraging sell-off, because not only price is dropping, the futures market positions are getting close and close. That is a deleveraging sell-off, and that is very well in line with what we discussed so far. Option market, on-chain market, the funding rate in perpetual dropping, and the option open interest dropping, the MVRV of the short-term holder losing its momentum, the realized price rate of change is the monthly rate of change is below the yearly. All of them, in addition to the deleveraging sell-off structure that we see in futures market, it is a very strong vector pointing out to the south. And when we are looking at the implied volatility at its low, that means the metrics are all pointing out there is a high probability that we head south. And if I don't know how big that catalyst needs to be at this condition, because we were hoping to see a catalyst in last 3 weeks, and we were calling for it. Hey, we need a catalyst. We need a catalyst. And to be honest, being above 104 after all this macro negative news, all this profit taking, all this capital net flow turning negative, the fact that we are above 104 is amazing. And I was talking about the lack of momentum since last week, but still we are holding above 104, which is significant. But I'll keep my ground and say these metrics are showing the lack of momentum, and still the downward pressure is the probability of seeing a downward pressure is way, way higher than an upward. But I could be 100% wrong. All I'm just going over is what is evidence telling us. To just speculate about what is the potential range or price levels that this downward pressure might see some support, we can look at the heat map by the CoinGlass, that they're looking at the open or active contracts in BTC market. As you can see, around 100,000 to 102, and around 190 to around 93. These are the very strong range that we might see some sort of support, because there are a lot of positions being opened in that range, and still they're open. And look here, like around 98 to 100,000, it was opening back in early May, and there's still strong density of the contracts remaining open there, and that we might see some sort of support if the price break below that. And above 10, almost 104, or around almost 104 to 1011, there is a strong sell pressure, and that can contribute to market if market try to break above 110 and needs much more like dry powder or buy pressure to break above 110, because we already tested that area and that range, and now we failed twice to break above 111. And these two ranges, the 100,000 to 102 and 104 to 111, are both capping the range, and failing either of them is a great indication that we're going to just continue to go that direction. 111, 110, and actually, if we want to be breaking meaningfully above that range, 115 is the range, the price I was looking for. And on the downside, if we break below 100,000, that is a very strong indication, or the initial sign of, okay, that range has been finished, and market most likely see price lower than 100,000. This is solely based on the perpetual market, and we can use the very famous chart that we use all the time, is the standard deviation bands around the cost basis of the new investors, which is around 98,000, and we failed to break meaningfully above the half a standard deviation since early June. We are just market is trading around half a standard deviation, which is now around 10. Let me zoom in. We are around 108. So if we want to see the market actually getting back to the bull market, we really need to see we breaking above the 1 standard deviation, which is 115. Again, like the perpetual market, 115 is where we can see, hey, all that bearishness that we were pointing out in last 2 weeks is over. Now market is showing a strong momentum, and breaking 115 is a very strong confirmation of the bull market is back, and we can hope for seeing 2 standard deviation or 1.5% deviation, which is around 125,000. But since, like I said, since late May, this fading momentum is causing the price to failing, breaking above 0.5% deviation, and it's just, you could see the bias to the south is getting larger and larger, and 98 to 100,000 is where I hope and I suspect we're going to see some support, like the perpetual market heat map. But if we don't, the 92, similar to the perpetual market, 90 to 92 is the second strong support that we should hope or should expect some sort of market going sideways in midterm. And these are the two price ranges that I would use to call for a bull market or a strong bear market. Around 100, 98 to 100 for the downside, and around 111 to 115 is where I would say, hey, no, we're gonna see a very nice bull market, and this is where the price is capped. And I want to wrap up this piece by just mentioning these ranges, because usually we try to be a little bit directional, but based on facts, not just based on just drawing some line on the price chart and try to be like speculating just based on linear regression. What we're trying to do is just using the Onchain metrics that is based on actual cost basis of the investors, actual behavior of the investors, and try to speculate the potential move upward or downward. I hope you like it. Please send your comments and questions through the platform, and I will be happy to discuss any question you might have, any doubt, or you see anything that could be explained better. We are trying to make this on-chain pod better and better every time. I hope you have a good week, and see you next week.